I want to discuss the concept of an event study. Now, event studies are very popular in finance for testing market efficiency. And market efficiency deals with whether prices really reflect information that's in the marketplace. And this methodology specifically is used for testing the semi-strong version of the efficient market hypothesis. The semi-strong version says that stock prices reflect all publicly available information. So stuff that you read about in the newspaper, things that are announced by a company, should be reflected in their price. And what we're interested in is seeing how stock prices move around some event. And that event could be the announcement of a merger, it could be the announcement of a stock split, it could be an earnings announcement, it could be a lawsuit, it could be any one of a number of factors that we think would influence the price of the stock. Now, when we do this, the event, whether it's the merger announcement or the stock split, whatever it is considered to be time period 0. And we'll look at price movements before and after the event. So that's what we want to do. So in order to do this, what we want to do is we're looking for abnormal returns around the event. You know, if the market's very efficient, then there shouldn't really be any pattern of abnormal returns. You know, sometimes they're a little higher, sometimes they're a little lower, but they're random, okay, and have an average or expected value of 0. So we need to define what would be a normal return if we want to calculate what's an abnormal return. So there's several ways we can do it. We can use a constant mean return model where the return for stock I in time period t is just equal to mu I, which is the mean, and plus some error term in that time period. And that error term has an expected value of 0 and a variance of sigma squared epsilon I. Another approach we can use is the market model. And the market model relates the returns for stock I in time period t with the return for some market index in the same time period. So that index is usually the S&P 500, but it could be really any market index we wanted to use. And it's estimated using linear regression. And again, here we're going to estimate a slope coefficient and an intercept. And the expected value of the error term we get, because this model, this line that we fit through our data, is not going to fit perfectly, so we're going to have errors in our estimation. And the expected value of that error term should be equal to 0, and the variance should be equal to sigma squared epsilon I. We could also use one of these equilibrium models, such as the capital asset pricing model or arbitrage pricing theory. Now, when we're trying to do an event study, it's good to look at sort of a little graphical image. Time period 0 is our event. This is the date of the event, and it's not necessarily the same calendar date for each company. So a company announces a merger announcement on, January 15th of 2006. Another company might have announced a merger announcement on, April 3rd of 2002. Those would both be event time 0. And in order to do this, we need to have some estimation window. This is where we're going to estimate our parameters, okay? Or if we're using the market model, the alpha and the beta. And then we're going to be interested in what happens around this event window. And then we may also be interested in what happens post-event window. Now, the market model tends to be the most popular method for determining these abnormal returns. And as I mentioned before, it's estimated using ordinary least squares, which is really quite easy to do because you can do it in a spreadsheet. Every statistical computer program you have does ordinary least squares. You can even do it on a scientific calculator. You can type in, your RMT and your RIT, and it will estimate all the parameter estimates. So you're going to estimate using data from the estimation window, which should not overlap with the event window. Okay, so we want it to be a separate set of data. So we're going to estimate over a certain time period, and then we're going to use the model to estimate the return for each firm at each time period. And again, time period 0 is going to be a different calendar date for each firm. You may even have a firm that's in there more than once. If a firm has announced stock splits several times, they may be in the data set several times, but each stock split announcement is going to be time period 0 for them. So once we estimate these normal returns using the market model, we're interested in finding what the abnormal returns are. And the abnormal returns are going to be the difference between the actual return and what the model predicts. So ARIT is the abnormal return for stock I in time period T. RIT is the return for stock I in time period T. And then we're going to subtract what the model predicts, which is this estimated alpha or intercept term, plus the estimated beta for stock I times the return of that market index in that time period. Now, one firm's abnormal return at a period doesn't really tell us very much. So what we want to do is we want to average over all the firms in each time period. So we're going to average up, we're going to look at each firm in each time period, and we're going to find what's the abnormal return in that month. And then we'll go to the next month. And we'll do that for all the different months. So you're not going to be looking at one abnormal return. You're going to be looking at an average, and that average might have 100 or 200 or 1,000 different companies that had that event on that event timeline date. So it might be time period 0, or it might be time period 0 minus 1, so one day before the event, etc. And if you were looking at a graph of these events, if there's actually no information from the event, the market's efficient, then you would expect that there's really nothing going on here. That, sometimes the abnormal return is above 0, sometimes it's below 0, it just sort of randomly goes up and down. Even after the event date, time period 0, sometimes it's below, sometimes it's above. No real pattern here. Now, if there's positive information from the event, you would expect to find some returns that are above this before time period 0. So the market is anticipating that Apple will have good earnings announcements. And in fact, as they get closer, they're even more optimistic, and the return from the stock goes up even more. But notice these are all positive. We don't have positive, negative, positive, negative. We have all positive ones here. And then after the announcement is made, we notice that it seems to go back to being somewhat random here. Some are above the line, some are below the line, etc. You can also have a case where the announcement is negative. We're expecting bad news, and you can see these are all negative abnormal returns. So we've estimated in a different time period, and then we're looking, let's say, 30 days, 29 days before the event, and we see that lots of negative abnormal returns. And again, once the announcement is made, it goes back to being sort of random around 0. Okay, sometimes a little above, sometimes a little below. Now, sometimes what we like to do is we like to look at the cumulative average returns. This gives us actually an even nicer visual to look at the impact of the event and whether the market is efficient or not. So what we're going to do is we're going to take take the average return in, for example, time period minus 29, so 29 days before the event, and then we're going to add it to, the number 28. Okay, minus 28 is going to be minus 29 plus minus 28. So it's going to be the average return for the first period plus the average return for the second period, and then the next one for the third period, etc. And again, we can graph these. So you can see here that, gee, there were all those positive abnormal returns. So cumulatively, the abnormal return should be growing. And here, this is the case where after the announcement is made, things flatten out. What does that mean? That means that people were anticipating the news. They thought it was going to be good news. So the stock price kept going up. And then once the announcement was made, okay, the news is incorporated into the stock price, and it just flattens out, and you don't get any more abnormal returns. And if you remember from my graph of simply the abnormal returns as opposed to the cumulative abnormal returns, they again randomly, sometimes they were higher, sometimes they were lower, they bounced up and down. So this would be the case where there is positive information from this announcement, and once the announcement is made, the market's quite efficient. It incorporates it into the market. So the market did a pretty good job of predicting what the news would be, that it would be positive. Once the announcement was made, everything was verified, and things just flattened out. You can have the case where the market overreacts to the event. Okay? They think the news is going to be better than it is. So they're predicting, a really good earnings announcement, for example, and so things are going up and up. Then once the announcement is made, it's not really as good as they predicted, and so things go down a little bit. Okay, so this is the case where, the market overestimated the benefits of whatever announcement it was, stock split, earnings announcement, merger announcement, etc. And after the announcement's made, they realize, things aren't going to be as good as we thought, and the stock price goes down or the return goes down. You can also have the case where the market underestimated how good the news would be. They thought it was going to be good, and then once the announcement came out, the news was even better than they predicted, so it continued to go up for a while, and then maybe it flattens out. So there can be several cases here, but these give us a nice picture as to what's going on. Is the market efficient or isn't it efficient? Okay, lots of studies have been done on event studies, looking at, the original was done by Fama, Fisher, Jensen, and Roll, looking at stock splits, but they've been done on all kinds of different events, such as merger announcements and earnings announcements, and we're interested in seeing, again, how the market reacts to these. So, fairly straightforward to do, quite popular in finance, and in general, we find that the market tends to be semi-strong efficient, that the market does a pretty good job of predicting what the news will be, and then once the news hits, it's incorporated into the stock's price, and things just flatten out, and you go back to having essentially zero abnormal return.